Hey, Bulls and Bears, back with another dose of economic reality. JJ here from Bull Boom Bear Bust. Yes, this is my second report today. This is Sunday, March 12th, 2023. You might be watching this on Monday, so it's kind of a late night output for my channel. But as the news gets hot and heavy, as big things happen, we're going to increase the output on this channel. We have a bailout of billionaires. A bailout of billionaires was just announced. Of course, they're not calling it that because I think too many people would get outraged if they called it a bailout for billionaires. But that's what is happening here. This is an article just out, actually, just like minutes ago. U.S. government moves to stop potential banking crisis. And we'll get to the important part here. First of all, most people know that this Silicon Bank failed. They had to be taken over by regulators. They had to run on the bank. Now, this bank was a heavy bank for deposits for the tech industry. And as the tech industry hit a lot of hardships, of course, we saw many, many layoffs, but they also had to start withdrawing money out of the bank to meet their financial obligations because profits were plunging so quickly. And enough of them pull the money out of the bank at the same time, it created a liquidity crisis basically for the bank, and what people would call a bank run. The bank run rather resulted in a liquidity crisis. So there you have the problem with this banking system, where banks don't keep money in the bank that people deposit. They actually loan it out many times more than what is deposited into their bank. So this is the problem, and this is why we're seeing it begin in a tech industry heavy institution like the Silicon Valley Bank. All right, but let's go to this article here. This is out of AP, and the reporting here is the third largest bank failure in history. The biggest one, I believe, was back in 2008 with a bank called Washington Mutual. If any of you are older than 32, 35, probably you remember that very well. Regulators had to intervene. Normally, FDIC's going to insure up to 250,000. So if you have less than 250,000 in a bank, the bank fails, you're going to get all your money back. The problem is if you have more than 250,000, you might lose a lot of money, or whatever you have above 250,000 is at risk. That's traditionally what FDIC has said and what they do when there's a bank failure. The game has just changed. We're seeing a billionaire bailout is what it looks like to me. Take a listen to this. In an effort to shore up confidence in the banking system, the Treasury Department, the Federal Reserve, and the FDIC said on Sunday that all Silicon Bank clients would be protected and able to access their money. They also announced steps that are intended to protect the bank's customers and prevent additional bank runs. So they don't want all the other billionaires looking at this, pulling their money out of these other banks, or any other banks for that matter. So they're trying to stave this off right away with this big announcement. It's no longer 250,000 is no longer the limit. So everybody, including the billionaires, people like Mark Cuban that I just talked about in my last report, said he lost between $8 and $10 million. Several other tech CEOs and upper level management people, a lot of billionaires, that said they had a lot of money in this bank, are going to get all their money back. So pretty amazing announcement here. Quote from this article: "This step will ensure that the U.S. banking system continues to perform its vital roles of protecting deposits and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth," unquote. The agency said in a joint statement. So that statement, when they say joint statement, that's a combination of the Fed, the FDIC, and the Treasury Department. Wow. Get into a little bit more about how this is happening, what type of actions are being taken to allow this billionaire bailout. In a separate announcement late Sunday, they announced an expansive emergency lending program that's intended to prevent a wave of bank runs that would threaten the stability of the banking system. We talked about the contagion in our last video, how the contagion's already happening. Fed officials characterize the program as akin to what central banks have done for decades: lend freely to the banking system so that customers would feel confident that they could access their accounts whenever needed. So essentially, the Fed is the new bank. So now, instead of having the middleman, the banks, the Fed is just going to give the money out to all these billionaires, or to the banks to give it to the billionaires to give them their money back. The lending facility would allow banks that need to raise cash to pay depositors, Silicon Valley Bank in this case, to borrow that money from the Fed rather than having to sell treasuries and other securities to raise the money. Silicon Valley Bank had been forced to dump some of their treasuries to raise cash because of all the tech depositors withdrawing their money over the past few months. Under the Fed's new program, banks can post these securities as collateral and borrow from the emergency facility. Continues here. Some prominent Silicon Valley executives and some billionaires feared that if Washington didn't rescue the failed bank, customers would make bank runs on other institutions. So this is what they're doing to try to stop further bank runs and a systemic failure of the entire banking system. Will it work? We'll have to see. Please let me know what you think down in comments. Is this the right thing to do? Giving these billionaires their money back, and not all billionaires. I mean, some people may have only had 300,000 in there, so they would have lost, about 50,000 if you had the cap at the normal FDIC cap of 250,000. So not everyone that's getting made whole here is a billionaire. Some people might have had $500,000, therefore, instead of losing 250,000, they're going to get their full $500,000 back, right? So is it right? Is it wrong? Is this going to prevent further bank runs? I still think there's going to be a lot of lost confidence in the banking system, but this is what they're doing, folks. A little bit more here. Under the plan, depositors at the bank and Signature Bank, that's another one that's having a bank run here, including whose holdings exceed the $250,000 insurance limit, will be able to access their money on Monday. That's just a few hours when I'm recording this. Under the plan, depositors will be able to access the money. Also Sunday, another beleaguered bank, First Republic Bank, announced that it had bolstered its financial health by gaining access to funding from the Fed and also JP Morgan Chase. So we have a combination of Chase Bank and the Fed coming to the rescue of this failed institutions to give all the depositors their money back, even those with more than $250,000. And here is the way that it's being characterized. The lending facility, this program, this new program, not new in its technique, but new as far as the way it's being handled in this case with this SVB bank. The lending facility will allow banks that need to raise cash to repay depositors to borrow that money from the Fed. So in order to pay their depositors and these billionaires back, they're essentially borrowing money. They're borrowing money from the Fed. So are they going to have to pay the Fed back? Remember, the Fed was supposed to be unwinding their balance sheet. They're supposed to be unwinding their balance sheet. We saw it drop from about $9 trillion down to about, was it $8.75 trillion? I haven't checked it here in a few days, around there. So now if they're borrowing money from the Fed, is the Fed balance sheet just going to start going back up? Is this the end of quantitative tightening? This is a liquidity injection. This is quantitative easing in disguise or under a different name. Borrow money from the Fed rather than having to sell treasuries and securities to raise the money. All right, people, let me know what you think about this. To me, it looks like a billionaire bailout. Can't think of any other name for it. Of course, they're not going to call it that. Please let me know down in the comments. We'll be back with more updates, everybody. Big love. Keep stacking. Bye for now. Peace.